Let us begin already. We've waited for a minute. Well, good evening, everybody, and thank you for joining us one more year. Thanks, Maria Jesus and the whole team that has been leading Santa Comba, because we don't normally get to hear about their achievements, and it's great to know in greater detail what they are doing. It's even more difficult than what we do. We have a clear objective, which is to get revenues and not to we don't need to make that compatible with additional objectives which are difficult to achieve. So thank you so very much for being here, and let us talk about several things this evening. Firstly, we'll be talking about Cobas and some news that are relatively important this year. Then we will talk about philosophy. We will go over the basics because, as you know, we've included an additional 8,000 new customers. So in case some of you are not very well acquainted with what we do, we'll go over that. And we will talk about the progress of our portfolios, and we will talk about how we, under the given uncertainty, it's the same uncertainty that we have 30 years ago. There's always uncertainty. Things don't change that much. But we will talk about our portfolios in the current context. Minkun, Vicente, and Ivan will talk to us about some investment cases, and then we will have a Q&A, and we will be delighted to answer to any of your questions. So let us begin. This year, we've reached assets amounting to 4.1 billion, with net subscriptions amounting to 755 million in the last year and 2 months of this year. We have 40,920 unit holders, and we have a plus 30%. And it's not that we take any subscribers, but anyone can become a subscriber of ours with 100 or 200 euros. And we're delighted to have so many new joiners, and we're still open to welcoming anyone who trusts us. We don't do any marketing, but we are very much delighted that people decide to underwrite with us and that they join us. And we are also very much happy about the fact that 75% of our customers, and by the way, these are the Spanish funds, but in Luxembourg, the situation is pretty much similar. And most of them are Class A. They have a 1% fee compared to 1.75 for Class D when one gets started. And most clients are enjoying an additional 0.75% compared to the normal commission. And indeed, this is not minor, because as you will see here, in the long run, if we actually assume the yields that we have, those of us that have been here for 30 years and 12%, well, we could have had those 100 euros become 898,000, and that's the difference between 1% and 1.75%, and these are the yields that you can actually achieve. This slide is very interesting, precisely because of that, and precisely of what a yearly yield of 10% means for 30 years. It means multiplying by 8 or 9 the profitability, the yields. I was talking to a 25-year customer recently, and he's going through the same thing that I went through 2 or 3 years ago when I had to withdraw money from some of my funds because of tax issues. And I was surprised because in this particular fund, I had, let's say, 50,000 euros, but I actually had 5,000 put into it. So, long-term yields coming from compound rates, compound interest, are huge. They're brutal. So surprisingly, he was saying, I had introduced 100 and now I get 1,000. So that's math. It's a magic of figures. So we must take into account, because in the long run, being patient and taking things easy and having peace of mind pays off and leads to these results. we have put together two new fixed income, two pension funds, one for freelancers and another one for companies. And the demand is out there, as everyone knows. We are specialists in equity, and we have a fixed income fund for this. There's people that need a pension fund, and that makes a lot of sense. And of course, due to the good performance of our fixed income fund, we didn't talk about it too much, but in the last 8 years, we've had a 3% profitability, 3% revenues, knowing that treasuries have been playing off 1%. That's not bad at all. And year to date, it's 5%. Some of the negative things last year have been positive this year, especially some bonds. But in the last 5 years, the yields have been quite decent. And we must say that this fund is invested at 70% into German government bonds and treasuries too. So it's actually the safest thing that you can do in Europe from our perspective, with an IRR of 10.6%, and 70% of the fund is invested into these bonds. And what is it that we do? Well, we add a bit of spice to this fixed income with equity. With that 15% is a high yield debt portfolio. It could be the Cobas Concentrados or Cobas Selección. And then we have private bonds. Fortunately, or skillfully, we've been able to find bonds in the oil and gas industry with IRRs reaching 9 or 10% with very low risk. Most companies that we invest in, we are shareholders for too. We know them very well. So if you want to run the risk of being a shareholder, it could be reasonable to buy a bond from them. For some of the companies that we're invested in, we bought bonds at 9 or 10%, and we're talking about companies that had net treasury. They had more cash than their debt. They had 120 million in cash, and they had to issue a bond at 9 or 10%. That's outrageous in the market. But why is that the case? Because some entities are banned from investing into oil and gas companies, and that creates a market deficiency, and we've harnessed it. And of course, it's quite helpful that our management fee is 0.25%, one of the lowest in the market for the fixed income fund. So it's a bit of everything in this mix, and all in all, we have a product that we don't speak about very often, but it's a clear alternative for the 900 million that are in deposits in Spain. Actually, if we go back a slide, we will see what we can actually expect: 3-4% yields. And in the worst case scenario, as we had in 2018-2020, when our equity portfolio falls by 50%, the drop is 10%. That's the worst thing that can happen, and it's always temporary. We will get back from that, of course, but temporarily that kind of drop can be experienced, and it can be 10%. So if you want fish, you need to get wet, as we normally say. And by the way, this fund has been recognized in Europe as the best European allocation fund by the Morningstar Awards 2026. So let us talk about further news. Something that is interesting, that we have a new addition to our management team. It's Carla Villarmin. She's not sitting here. Please stand up so that everybody can see you. Of course, since you're not up here, please let them see you. You need to stand up for a bit longer, please.
Bueno, pues después de 8 o 9 años, pues
After 8 or 9 years, we've taken the big step of including one more person to our team, and we're very happy about this. And sometimes I say, Carla, have you done this, or was it AI? Because it's so well written, and of course it's been her. And then something that is quite important is our fund closure process. That is coming closer, just as the screen is coming closer. And we're structuring this. And of course, we can already share with you some hints as to what we're going to do. We're going to partially close Cobas Selección and Cobas Internacional, Cobas Selection and Cobas International. Why? Because we want to preserve our capacity to generate value in the long run. We are here and we get paid so that we can make profitable the money of our subscribers. We're not here to capture money. If we do so, we're delighted to do so, of course. But the objective is to make those funds profitable. But at some point, the size of those funds makes it difficult to invest in certain companies. Like, for instance, currently our international portfolio is managing 4 billion. This means that in order to acquire 1% of Cobas Selección and Cobas International, we need to buy 40 million from a company, and 1% is the minimum position that you must have in your portfolio. So buying 40 million of a company means that a company with 500 million market cap, it's a large company, not many in Spain make it to that level. It's not easy to find that type of company. You need to buy 10% of the company. You need to request 40% to have 1% of the fund. You need to have 10% of the company, and it makes it difficult to buy into small companies. And this is where most value is to be found, as we always say, in large companies, big corporates, you can find very little. Microsoft, General Electric, banks, there's very little that you can add to the mix there. But in smaller companies, you can play a role. So that is the ultimate reason. Obviously, this reason needs to be balanced out with, of course, the fact that they have enough of a size as a company. Because when you have a small size as a company, you need to grow to acquire a minimum size so that you can have access to all the market tools, to the available information, etc. And we already have that type of size. So we think that it's the right moment. Time is ripe, and we talked to the regulator, and we have an agreement on the principles that will steer how we're going to go about this. We will close the funds to new subscribers, but current subscribers will be able to continue to invest at least temporarily up to 5 years. Well, I cannot really tell, but during a relatively long period of time. And also partners and descendants, young individuals, will be able to continue to invest into these funds and the D series, which is the one that they should be investing in. So this is what we intend to do. When will we do this? Well, rather the time, we have amounts in mind. When the two funds reach 2.5 billion under management, slightly above, slightly below. And Cobas Selection is at 1.3 billion, and Cobas International at more than 1 billion. So it could be this year or maybe early next year. And if we are unfortunate, then maybe in 2 or 3 years' time. But the fact that we are meant to close it, that means that good news. And this is what we intend to do. And maybe the figures will change slightly, but these are the ones that we have in mind right now. We're reaching them, close to them, and everything's ready. And when the circumstances are right, then we will go ahead with it. And let us talk about philosophy slightly. And many of you are acquainted with it, but we thought that it was necessary to share this with a new 8,000 subscribers. What's happened in recent weeks with such good yields, people may think that this is paradise, and it's happened in the past, but it's not really the case. We really need to go over what we do and what can happen, good, bad, and not so good, not so bad things. So what we want to do is to be in solid, long-lasting businesses that are leaders in their industries, and that is difficult to take their position away from them. And that means that the ROC is currently close to 30%. And those companies that have invested in machines or whatever it may be, they're generating 10%, and that's a lot. Any business that you find out there in the street that is yielding 30%, that's a lot. So these are ROCs of very good quality companies. We also want to have interest aligned. We are fund managers and we know how to assess things, but we don't know how to manage companies. So we need people who can manage them, and we need the families and owners in the mix, and we want to be aligned. A great percentage of our companies are family owned, and our interests must be aligned. Now, this is also very important. We do things against the tide, because if you do what newspapers do, you get a 5 or 6% yield, and you need to do different things. So what's the fun in this? Otherwise, what's the beauty in this? So we buy in small companies. We're talking about a weighted market cap of 5.5 billion, and we normally have access to rather small companies. Some large exceptions, but normally these are small companies. And we are contrarians in a way. We have been significantly in oil and gas, more than the market. And what is it that we're doing now? We are selling oil and gas. Now the oil is at 100, 120, and everybody's talking about that, the fact that there's a lag. We always say that you need to buy when nobody wants to buy, and you need to sell when everybody wants what you have. And this is what we constantly do. And you need to be mentally strong, and you need to have quite a personality, but that's the only thing that you need to expect from a good investor: personality and then strength. And finally, this is essential. We never ever buy companies that are above 4 times multiples. And when you think I'm going to be buying something on 30 times multiples, what will happen in a few years' time? We buy at 8 years, and we can settle for that. And because the funds have been behaving quite well, this is at the top end, and there's been decreases. And you talk about 2027, the PER would rather be 7. In 8 years, you will be recovering your investment, and then all cash flows that come afterwards, they're for free. So we lower the risk quite a lot if we buy one-digit multiples. Then patience. I mean, without patience, investment doesn't exist. It becomes something that is speculative and short-term. And in order to do that, you could just put your money into rum and coke and have more fun. So this is something that we have been doing. We're long-term investors. We were invested in Elecnor in the past, but we're no longer in their investment base. They did so well that we're no longer shareholders. Danieli is a similar case. Now we've reduced our investment because they have actually multiplied by 10 since 2008. They've multiplied their results by 50% at Elecnor. In the last few years, it was 4, so I don't even want to make the math, but to do the math. But all this is the result of patience, because people were saying Elecnor is such a boring company, nothing happens there, but things do happen, and in order for them to happen, you need to have patience. And then we have volatility here. Sadly, volatility is the best thing in the world for us. The more volatility, the more things that we will be able to do, and indeed, if what was happening weren't happening, it's sad, we wouldn't be able to sell oil companies, and now we're buying companies that have regrettably fallen by 25%. So the market movements are what offer us the possibility to be contrarians and to do more transactions, to create more movement, to create more value, and to increase the value of our fund. And actually, last year we sold 22 companies and we bought into 25, and this is not going against being a long-term investor. For more companies, we remain shareholders for more than 7 or 8 years. But when you need to rotate your portfolios because things are going up, this is what we do indeed. And now about risk control. Low net debt, And that needs to be clear. Practically most of the companies that we're invested into have no debt. They have net treasury in the bank, most of them, and that is essential. We also need to control our weights. No industries are more than 20 or 25% of the portfolio. You can't get things wrong because you can never be certain about what's going to happen, but you need to know that you need diversity because some things don't go well. This year, for instance, petroleum or oil is supporting us and gas too. But last year it was detrimental for us, and the year before that too. And we had a yield in Cobas selection with some oil companies going down by 60%. So we could take the hit because some other companies perform very well. And this year, other companies are performing badly, and oil and gas is performing well. And you need to have a well-balanced portfolio because you can never tell what industry will behave or perform well in 1 or 2 years, given the circumstances. And of course, having a high potential involves buying at low prices, and that's part of our genome, our DNA. It's everywhere. It's across the board. And we also talked about rebalancing the portfolio. That helps us reduce the risk. When you have an IRR like Elecnor's of 4%, that doesn't mean that it's going to be dropping. The possibility of creating yields at the company are lower. So you need to rebalance your position. But we must bear in mind that we have a huge advantage in investment funds, which is that we don't pay tax. We pay 1% corporate tax or capital gains when we're selling actually nothing. So there's no cost to buying and selling in these portfolios. I mean, the fees are very low. So all things considered, we can do risk management, risk control, and it makes it difficult for us to lose money in all companies. We may get things wrong. In the last 3 or 4 years, a couple of companies have gone bankrupt, but this rate has decreased quite significantly. And something that is very important, that it was not included in the presentation, but it's something that I learned in the last 10 years in Cobas, is that time is of the essence in investment. When you invest in a company, you can perform a due diligence for 4 or 5 months. You can wait for 6 years to buy a company, but until you become a shareholder and you remain a shareholder for 3 or 4 years, you don't know them, because over time some people come and tell you bad things, good things. That way you can actually get a better flavor of the situation. And I'd like to quote an English manager that I learned from. He said 3 or 4 years ago that he never invested more than 3% of his portfolio after 3 years of being shareholders. This is something that Andrew Foster shared, and this is a very good starting criterion. And the last part of our investment policy is about knowing ourselves and trying to not hurt us too much. We don't want to commit suicide, but you can actually afford to cut a finger or a foot sometimes, and we don't want to be too emotional in our decision making. And this happens to all of us, to professionals and amateurs. So we really need to be masters of what we do, being acquainted with what is it that we're into, knowing that things are worth their worth, that you may be buying at a discount. And here we have a team that has been working closely for many years. We are very much acquainted with our companies, and if anyone has some sort of emotion, then the others try to temper them. So we do checks and balances with one another, and that is quite fine. This whole list of things provides for the different features that we have been discussing. By the way, these were last year's yields, and this year's 2 months. We have ROCs of 80% and 30% rather. We have a free cash flow yield of 16%, which is huge. A very low net debt controlling group. And then we have the weighted market cap of 5.5 billion and a VAR of 1.8%, which is quite good too. it seems easy, but sometimes things are not so easy. So what are the challenges, the problems to be considered? Major temporary market downturns, and not just the market, also the funds. Here we have a few examples. Some of you may be familiar with this. Those of you that are newcomers may not be acquainted with this, but those that have been in here for a while, we know about this. There's been 5 times that in which there have been decreases, and 98, 2002, 2007, 2009, 2011, 2020, and this is something that of course is unavailable. We're talking about 10-12% yields annually in the long run. You get those figures with these drops. If these drops wouldn't happen, then we had much higher returns. But from time to time, you need to go through these situations, and you need to go through them with dignity and peace of mind. And if you get nervous, do what I do. Don't look at what the funds are doing. And some people will say, oh, they're back up. And then you look at them again. And this is what one should do. And if no one says anything to you, full silence, total silence, okay, that's fine. That way you don't suffer. This is what I do. No one's Superman here or Tarzan. And the good thing about this is that quickly you go back to green. So the more you fall, the greener it becomes. And this is the story. Actually, when you're buying at 7-8 times profit, then this goes back. And no one in life will sell you a company at 6, 7, 8 times profit. So good things happen. Things happen and good things happen. People quickly find the money to invest into this value investments. And sadly, markets go down from time to time, and we wanted to underscore this because for 5 years, back to back, we've been seeing increases, and recently we've been seeing some downturns. But in case some people didn't have this in mind, we wanted to remind you of this. And it's also true that if what we do were so easy, we would be going above market constantly, and it would be a walk in the park. But it's not true. Sometimes the market tries to put us back in our place, and this is a graph that depicts the year 1993 until current times, and we have the different funds that we have managed here. And the MSCI World Global Index, MSCI World Global Index. And here you have that if you invested 100 euros in 93, currently you would have 4,407 euros, and with a model portfolio compared to 902 in the global index. You cannot see it very well here, but fortunately, time flattens this. But in the year 98, 99, we did have issues, and you can see a drop in the green line when the gray one was going up. Then in the year 11, 12, we also had some issues, and especially from 2018 through to 2020, markets, just like it happened from 1998 until 2000, there was another technological bubble, and the market was going in directions where we weren't, and there were some errors, some mistakes there, but basically that was what happened, and it is what it is. And I'd like to insist on this again. When we buy companies of the quality that we have at ROC of 30% at the price that we're buying them, those things are temporary. It's very unlikely that companies that are at 20 times profit perform better than our companies at 8 times profit. It's quite unlikely because these are leaders in their industry. But the great advantage of our company is that in addition to this, we're talking about very stable businesses. You have quite a good visibility of what's going to happen in 10 years' time. So for those companies that are 25, 30 times, these are normally companies that are enjoying glamour, and everybody wants to be invested in them. And it's complicated that they will be able to sustain these multiples over time. And of course, if you want to compare to Standard & Poor's, Standard & Poor's did better than Morgan & Stanley, but they performed worse than we did. And now let us talk about ourselves and our portfolios, and specifically about the state of affairs.
The international portfolio continues on having a not 100% potential as we had last year, but 84%, because we've been able to recycle some of the companies who went up by others that have dropped, and we've been able to increase the objective price. What's interesting, and you can see it here, is that 197, we're already above the target prices that we have for 5 years ago. For 5 years ago, we thought, well, we're paying 100, and this is valued by 190. We're already at 190. Now the objective price might be 360. I don't know. In 2 years, we'll be there, because the price of the things is the price of the things. If the company maybe are being valued at 7 times the benefit, maybe they are worth 15 times. So we know that they're going to grow. Same thing in the Spanish fund, in the Iberia fund, because if we take a look at what happened last year, we're already in the value of what we mentioned 3 years ago. In 2022, 2023, we were saying that this was going to be worth 230. We're already in this 230. It is true that in those moments of setbacks, they say, when are we going to achieve it? We don't know, but we've done it in 3 and 5 years. We've been able to reach our targets, in some cases a little bit longer, because of the issues that I spoke about before. So we don't fully know, but the only certainty that we have is we'll be able to reach these objective prices, and the potential will be seen over the course of the years, without a doubt. It was always that way. Things are not going to change now. This is the profitabilities of last year, as of March, and this year everything is in positive. The Iberia fund is in positive, and 10% we've been achieving in the international portfolio as of the 21st of March, only a couple of 3 days ago. Obviously, we are not protected versus market movements. In the last years, we were benefiting from having a 20%, 30% in gas and oil, in energy, and in most of the cases, we have been benefited by this. Not in all corporations. Curiously enough, Técnicas Reunidas has fallen drastically, but it's starting to recover. But in general terms, of these corporations have benefited from the fact that there is less gas and oil. And how is the portfolio right now? It's more or less the same thing. This is as of 31st December 2025. Probably this has dropped a little bit at this time because companies have revalued, but at the same time we've been selling. So I don't know what is our net position. Probably a bit lower than this because we're selling. In some of them it grew very much. It's hard to quantify. The defensive ones we've sold, and in residences and education we've sold, but above all we've sent defense. Everything that's fashionable, we don't want to know anything about. And we were shareholders of some of these defense companies. We've been so for 6 or 8 years. Same as with Avio, we presented last year as an example. It is not a part of our portfolio anymore. But this is the market. If it goes from 10 to 40, it's not the same at 10 and at 40. We're not going to be investing at 10 and investing at 40. That would be weird. It could happen, but it would be weird. And those are the most relevant movements that we have. We've gone into defensive consumption and some cyclic things. We've invested in Wizz, an airliner that is very cyclic company. In commodities, we're more or less in the same situation, and the rest I'm not totally sure what it is, but it's a 5%. So the portfolio is pretty stable. Now that everyone is talking about defense, we're out of defense. We go always against the tide. Now that everyone is talking about gas and oil, and we're going to consumption companies that are being penalized. And the same thing happens in Spain. We started doing it last year, and we continue on doing it in this one. The greatest change in here, as in cyclical companies, we're including Meliá, correct me if I'm wrong, and real estate companies. We've increased the weight of Meliá, and Atalaya, we've reduced its weight pretty much. And this is one of the most important changes that we've had. But this is the structure of the portfolio, as I was saying before, pretty diversified with a little bit of everything, and this is what we do and what we have. And now we're going to what is a concern for a lot of people within my environment and my family. What do we do? An investor with us doesn't have to worry about the fund going up or down. We worry. Where a stock goes up very much, we worry. We decide whether to sell or to buy. These are the 12 greater companies in Cobas Selección. A very important representation of the most important companies. Out of these 15 companies, we only have 6 in our portfolio. We've sold 9 of them. Wilhelmsen that we just purchased, Aritza, 7-year shareholders, Seaways, International Petroleum, that we're going to hear about them, or Elecnor. We got rid of them. We got rid of them. You can see there how we started selling them and the contribution that they've had. Seaways 3%, out of the 100% that we have, 3 coming from Seaways, 5.8 of TK, 7.6 Maire, 9% Babcock. They amount half the profitability that we've had. So at least with these companies, we're not losing money anymore. We might earn with the other ones, but not losing with these ones because we've sold them. What did we do? We have another 15 companies that we have right now in our portfolio as of December 31st. And as you can see, we only have 3 of the previous ones with a relative important weight, which is Golar, Atalaya, and Danieli. In Golar, we've dropped from 7 or 9% that we used to have to half of it. Now they amount 4%. Atalaya, more or less the same thing. It went up, it went down, but we're maintaining 4.2%. And in Danieli, we've also reduced our position. In Cosmos, we've also reduced our position. We've reduced the positions in the ones that we had at that time. Carris, Danieli, Atalaya, they have all behaved in an extraordinary way. Cosmos a little bit later, but we've reduced our weight and we've recycled in these companies that we have: CK, Hutchinson, BW Offshore, BW Energy, Wizz Air, a little bit of everything. So these portfolios or these companies at 8 times profit is giving us the same amount. And with this, I'm going to give the floor to Izad, then Vicente, and then Ivan. Min Kun first. Hello, good evening, everybody. I'm Min Kun. I'm the manager of Cobas International.
In English, because it's more professional part of the thing. So let's go. So today I'm going to present a case study for Samsung C&T. So Samsung C&T is a conglomerate in South Korea, and it's a kind of holding of the Samsung family, the Lee family, the richest family in South Korea. And today I'm going to present what is Samsung C&T, the business, and then walk you through the journey we invest in them throughout the years. So first one, let's look at the sum of the parts valuation of Samsung C&T. We start investing in C&T in 2018. And then the price there, when we invest, is 120,000 Korean won. So the price here is Korean won, so 120,000, the price we invest. And by then, we have a target price for the company, 245,000. And I want to point out the most important part of the Samsung C&T value is actually Samsung Electronics. It's a listed company, and the value of Samsung Electronics is already 150,000, which is already above the share price when we buy it. So what is in this Samsung electronics? So roughly 60% of the electronic business is about semiconductor, and mostly about memory business. And the memory business, we will go more detail in the next slide, but now just remember, it's a very important part of the business. And the other 30% of Samsung electronics is mobile phone business, Samsung Galaxy, the TV, the home appliances like air conditioner, washing machine, refrigerator. These are all consumer business, so it's very easy to understand. You can see it on TV everywhere. And the last part, 10% of the Samsung electronics is about display. So this is the phone, the display on your mobile phone. And it's not only in Samsung Galaxy, but also in Apple. For example, in the Apple phone, the new Apple phone coming, the foldable phone, 100% is supplied by Samsung Electronics. Let's go to look at the most important part of our business, which is the memory business. So this is a chart showing the historical revenue of the memory business. So there's few points I want to highlight. Number one, as you can see from the dark green in the back, it's a growing business. And maybe I want to elaborate a little bit what is the memory. So just try to think when our brain taking a task. So the brain starts working and they need to process something. And these data that you process, they are stored in the memory. So in fact, it's everywhere. It's in your mobile phone, your PC, your TV, in the server, in the cloud, it's everywhere. So the growth of this business is supported by all these kind of application in our life. So for example, in the early 2000, it's a PC. Then you have a mobile phone in 2006. And then you have a server when you have a lot of cloud service in 2018. Then recently it was because of the AI, the industry has a very big boom. And second point I want to mention here is the industry has a, if you look at the supply side of the industry, it's an oligopoly. There's only very limited players, actually only 3 big players in this industry. Perhaps maybe 4 players because the Chinese is playing catch up, but very limited players in this industry. Ever since 2013, 2014, the industry has consolidating into a very fewer players. And the reason why is because the barrier to entry of this business is very high. So the most important barrier to entry is the economy scale of R&D investment. I will give you an example. So today, if you want to start a fab, which is a factory to produce the memory, economically fab is cost you $10 billion easily. So 10 billion, and this is only the fab, the factory. You need to invest a lot of money every year in order to improve your technology to make it smaller and more competitive. Otherwise, you are out of the game. As an example, this year, Samsung will invest $75 billion just this year. And TSMC, the other semiconductor business, leading business, invest $50 billion. So we are talking about billions of dollars investment, and that is a very high barrier to entry. So, sorry. Okay. So what else in Samsung C&T except electronics? So if you look at the second pie here, it's Samsung Biologics. This is a manufacturing business of biologics drugs. So this is a very high growth business. You know, as many more biologic drugs is discovered and many big pharma, they are start outsourcing their manufacturing business, manufacturing activity to a very more efficient players, and Samsung is one of them. And this business require a lot of, again, in investment and efficiency. So again, it's only, I think, 3 or 4 big players playing. Fuji Film, Japanese, and in Switzerland, there's a company called Lonza and one Chinese, and not much more. So these few players is actually enjoy this high growth. When we look at the company in 2017, the sales was half trillion, so 500 billion Korean won, and today is 5 trillion Korean won. So the sales size has doubled 10 times in 9 years. It's really high growth. And Samsung is very competitive here and gaining market shares. So it's a fantastic business. And when we look at the company, they are just start, so they are turning profit. Profit is very small. I think it's 150 billion won, and we put something like 20 times PER. So we have reached this 30,000 per share value as in the Samsung CNT shares. So this is the second part. And the third part, Samsung CNT has, apart from the listed company, they have some operating business. So this is the third pillar of the value. And here, the majority is engineering and construction business. There are many others, but this is the key. And so what do they do? They build all kinds of things. So for example, they build residential high-rise buildings in Korea, and they build civil projects like airport, solar plant, and also they build a high-tech factory for Samsung Electronics. As a matter of fact, a very fun, interesting fact, if you take a look at the world's tallest towers, you look at the list, the number 1 is the one in Dubai, and number 2 is the one in Malaysia, and those 2 are actually built by Samsung CNT. So this operating business, in general, generating about 400 to 500 billion won every year when we look at them. So we put 15 times PE on it, then we reach this 40,000 per shares in the Samsung CNT. And the last part is other listed company, and for example, they have a stake in Samsung Life, which is an insurance company. And they have Samsung Heavy, which is a shipbuilder. They build all kinds of ships like LNG carrier and offshore vessels, etc. So all in all, we are looking at a company that is either number 1 or number 2 in all the business that it has operated, and it has been there for ages. So it's a very good combination of a very good business. And secondly, we are buying it at a very good discount. You know, just the Samsung Electronics already cover your cost and more. And there are many things the market basically puts zero value on it. So next one, I would like to take you through the investment journey with Samsung CNT. So if you can see here, we entered it in 2018. You know, the share price was about 120. Then and our target price is 250, more or less. So we are talking about almost 100% upside. So we start with a position a little bit less than 2% in our portfolio, roughly 2%. Okay, and then with time, the share price didn't move much, but with time we find more value there. We increase our target price 2021 more or less, and then the share price even fall down a little bit. So we start to adding a little bit our position there, and at the peak almost like 2.5%. Okay, and then as time goes by, probably start from last quarter of 23. The share price start to react a little bit, and then afterwards, because of this AI boom, the memory business get a lot of more upgrades, and the share price goes up, and then we start to selling our position. So basically, when we sell, the price is almost 220, with the target price 350. So the upside is reduced from 100% plus to 50%, 60%. So in this case, we exist our position and we move the cash into our other things in our portfolio that give us better opportunity and upside. So with this, I hand over to Vicente.
Thank you so very much, Min Kun. We're going to review other investment case. Wilhelmsen has been in our portfolio for these many years. We just finished this position last week. Wilhelmsen is a company that we presented here in this same event 3 years ago. We started with a very small position, and as we gain knowledge, we increase gradually our exposure to the company. The first thing that I wanted to say is why we bought it in the past, and the main reasons were that it was a company that it is a family holding. There's a family behind the corporation, a holding with good businesses that lead the segment and with a good balance with net cash in the holding. Now we're going to be taking a look at the different businesses that they have in the holding. In this graph is the initial valuation that we have when we started with our position in 2017, and with the different businesses. What we do when we do the valuation of the holding, we do the sum of the parts. We get every business that they have with the percentage that they have at stake, and we value. For example, Wallenius Wilhelmsen is world leader of transportation by vessel of cars with a 20% market share. They have 125 vessels. Most of them they are owned by Wallenius Wilhelmsen, so it's a very growing and important business. Then we have Hyundai Globis. This is the logistic arm of the Hyundai Group. We were in team. Min Kun did the model because of his knowledge of the Hyundai Group in Asia was much better, and he was closer to the company more than I could have. So he did the model, and I completed the valuation. Hyundai Globis is the logistic arm of the Hyundai brand in transporting cars, components, spare parts, and so on. Then we have the third business, which is the maritime services business. Different from the other two, it's not listed, so we had to do a greater work, and we got in depth in order to know the business better. But it's the jewel of the crown. People do not understand it, but it has a very important component: the return on the capital employed of 30% sustainable over time. And they do two things. They sell services and products. They are participating, or they are present in more than 2,000 harbors in the whole world, and they provide services to the whole world fleet. People in customs, insurances, material reception, and they produce also products for the maintenance and service of the vessels during their day-to-day cleaning products and so on and so forth. And then we have the new energy businesses with some renewables that is not so relevant, and the net cash. With this, we got a valuation of 550, and the purchase price at that time in 2017 of 250. So we have a potential of more than 100%, and that's why we decided to buy it. Good business, well managed, with a family behind, with a good balance, and this is what we liked. And now we're going to explain how we were managing the day-to-day of our position. This graph show in the green line the price of the stock, how it was in the stock market, and in black the target price, and on the background the weight in our portfolio. What you can see at the beginning of the purchase, we have a 250 price, and the objective price was 550. What happened then? Well, first of all, the stock market price fell, and then it was further increased with the COVID. We saw a drop of 50-60% that was very relevant. Why? Firstly, because it was a cyclic business. Transportation of automobiles and heavy equipment is cyclic, not only based on supply and demand, but you also have to take into consideration the supply of demand of vessels in the market. We were were in the low part of the cycle, and that drop was exacerbated in 2020. If you see the upper line, which was our objective price, it more or less remained stable over time. So we decided in this low price to increase our position, because that potential that was 100% became 300, 400%. So we took advantage and we increased our position for this 2% that we had initially to 4.5, becoming a very important company within our portfolio, as Paco was explaining before. And after COVID, the market saw the recovery of the cycle in the sector, because there was tremendous scarcity of vessels, and we were seeing the exports increasing for China. And this has been reflected by the market in terms of the stock price. Our valuation has been increased, and as the security margin has dropped, we've been buying. And we don't take a look only at that company, but we do a comparison with the rest of the companies within the portfolio. We see the potential of this company versus others, and that made us make a decision. And as the security margin was reduced, we started selling. So we went from an initial price of 200 and so, and it went to 700, practically touching the target price. To conclude, well, favorable business performance, as we were saying before, that came with an increase in the dividends. One important thing is that they have done some share buybacks, which is not something that we get into. We don't want to manage the corporations, but we try to keep a very constructive dialogue with the companies as to the things that can improve, and the share buyback is something relevant to us. And then the share price has tripled. With this, apart from the favorable business performance, I would like for you to keep 2 or 3 important ideas. Some of the lessons learned from this example is that you have to be patient. We started, but it took us quite a while for the market to recognize the value of the corporation. But when you have a good business, before improving, they worsen because of the cyclic part, and you have to be patient. Then you have to be knowledgeable of what you're buying, because when they fall 40, 60%, you have to know what's behind the corporation. You have to do a good due diligence, seeing the positive and the negative scenarios, where are the risks and where are the opportunities, with good allocation of probabilities. And at the end of the day, the market puts you under a very important test, but we were patient and courageous, and we ended up passing that test. And also our objective is to purchase good businesses with important discounts. That's a very important way of creating value. But when the market price drops, you can create more value if you increase your position. And that's the type of management that we can do. Reevaluating things and increasing our position can create a lot of value, because it comes with huge potential, and you have more probabilities in your favor. And that's the story of Wilhelmsen. And with this, I'm going to give the floor to Ivan, who will give us some ideas about just one clarification. Up until now, we have spoken about 2 companies that are not part of our portfolio anymore, and as an historical example of what we do good. And now we're going to talk about Meliá with the highest position in our portfolio.
As Paco mentioned, both Samsung CNT as Wilhelmsen are examples of how we created value in the past. But now we give you one example that goes to show what we're doing now to create value in the future. And in order to do so, I'd like to share with you the case of Meliá. Why is it that we like Meliá? I'm about to explain it to you. As users and as customers, there's no doubt as to why we like Meliá, precisely because of the reasons that you can see on the screen. But we are here to understand why we like Meliá as investors. And I'd like to share one simple and straightforward investment, which is that Meliá is a typical good, beautiful, and affordable company. And now we'll see why. One difference that sets apart Meliá from the competition, compared to the competition, is that they own most of their real estate assets, and most of their assets are irreplicable. That means that you cannot build by them, as you can see on this image. And additionally, Meliá has a founding company, the Escarrer company. They hold more than 50% of the company's shares. And over the course of these years, they have shown their know-how and their long-term perspective. And they have shown this for more than 20 years that I've met them, but I've known them. And Paco, perhaps in your case, it's more than 30 years or even more than 40. But a good example of their savoir-faire is their positioning from 3 stars to 4 to 5 stars. What did they achieve with this? They got access to more affluent customers, customers that are more resilient in the face of bad economic cycles. So this repositioning, together with the sale of some real estate assets, allowed them to weather COVID without having to resort to a capital increase. And let us remember that the COVID was the worst crisis for this industry. This is history. It was 5 years ago. But what is the current financial situation of Meliá? I would say that it's healthy. It's a healthy financial situation. And what does that mean in a few words? They have no problems with their debt. And if we compare their debt with the EBITDA that they generate every year, the operational profit that they generate every year, or if we compare the debt with the value of their assets, there is no problem whatsoever. But you will say, okay, what's the value of their assets? So another additional feature of Meliá's is that every 2 or 3 years, approximately, they get a valuation from an independent expert. They perform an appraisal of their real estate assets, and only that appraisal is worth 18 euros, and their share price is 9 euros now. But they don't just hold the real estate assets; they also manage their hotels and third-party hotels, and that's their management business too. And that business generates roughly 100 million euros a year net from staffing costs. So you will ask me then, what is the value of this business? And actually in the industry, there's been transactions at 10 times EBITDA. And actually, there's a few of their competitors that have a share price that is above 10 times EBITDA. But I would say that irrespective of the multiple, it's obvious that Meliá is worth much more than the 9 years that the market says it's worth. And because of all these things, we like Meliá. It's a good, beautiful, and affordable company. Good management, beautiful assets, as we just saw, and affordable. And due to all this, its weight is almost 10% in our Iberian portfolio, 2% in the Selección fund. And because of all these reasons, we consider that our investment in Meliá will yield more value in the future. Thank you very much. And now Paco will draw a few conclusions, I think, to finish off. Thank you so very much. Well, our conclusions are that we continue to like our portfolio. We have done some turnover, some rotation in some of the investments because with this we managed to increase the target price. That is our job. We cannot lead the share price, but we can control the target value indeed. And of course, we've talked about diversification. We've discussed this. We try to be in different industries to hedge against the different risks with good profitability and good potential. And because of all these things, well, we must say that we've achieved this by working together, some of us for more than 20 years. Vicente has been here for shorter, only 10 years, because he's very young too. So due to all these reasons, I do believe that we have portfolios that are fit to face anything that arises. If the oil goes up, then great. All the things go up, then great too. Anything that may be thrown at us, then that's fine, because with the good businesses that we have, I think we're ready. So let us not be concerned about the uncertainty that we've had in recent times. We are working on it from the inside too. And thank you very much for listening to us. And we are now looking forward to answering any of your questions. Hello, good afternoon, and thank you for your presentations. Good evening. Before we open the Q&A round, we would like to share with you a couple of initiatives that we've launched at Cobas in this last few years, especially Brainvestor. It's been with us for a few years, and we would like to remind you of the importance of managing well our emotions. Paco talked to us about this when we went over our investment philosophy, because of course emotions impact managers and investors, and this is why we launched Brainvestor, so that we can make better decisions in investing. For those of you that don't know it, we have more than 5,000 people in this community. You can download it for free, and there's very useful contents that can help you with your decision making. And I'd also like to mention that we have a mentoring program. It's also free of charge. Those of you who are not investors and want to start learning a little bit about this world, you can actually access it too. So our investor relations team works on this, and this is applicable to any type of investors that have advanced knowledge, but it's open to all of you. Also, we have online and face-to-face workshops. We normally try to get quality speakers to help us better understand how to manage our emotions when investing. And actually, last year after the summer, we launched Cobas Plus. Some of you have already signed in, and this is especially linked to pension funds or savings in pension funds. We've oftentimes talked about the problems that there could be with pensions going forward, and that we need to complement our public pensions with private savings. And we would like to offer this to savers, especially those that are younger and that may have some issues generating additional savings with all the different costs that they need to bear. So they could harness different purchases that they make in shops by adding cashback based on their purchases. And this cashback can be put directly into their pension plans. It could be Cobas Global or Cobas Mix Global, and that way they can save without realizing it. It's good to generate a good savings habit, and this is what we try to promote through this tool. I encourage you to download it, and in this case, you can add to your annual contributions to your pension plans. And having said this, we will open the Q&A round. As we mentioned in previous years, you can scan the QR code on screen to ask your question, and actually on the app that you are seeing this broadcasted on, you can ask your questions. We have received more than 300 questions in the past few days. And actually, if you're here in the room, you can write down by hand your questions, and they can send in. They can give them to us directly. So we will have 45 to 50 minutes for questions. There's very many questions, but the questions that are not answered live will be answered by our investor relations team. Let us start by tackling the first question. It has to do with the closing of funds. Arturo is asking that, well, he's saying that he has been recommending his friends and acquaintances to invest in Cobas in the last few years, and with the closing of funds, he won't be able to continue to do so. So what is the alternative that we can offer to him? Well, we must understand that not all funds are going to be closed. There's an additional question, which is, can we continue to make contributions into the Iberian Fund or in fixed income? That was asked by Marta. And in that case, what would be your recommendations in case we need to invest outside Cobas? But we have some options in-house, don't we? Well, as we just mentioned, we would only partially close. Well, what they have to do is to quickly tell his friends to invest before we close to the remainder of friends that haven't yet invested into our funds. But in any case, we are only closing selection and international. And the Iberian portfolio and the concentrate portfolio and the large corporate portfolios, they will continue to remain open. And because of the size of the funds, it doesn't feel like we will be closing them in the short run. I think the large corporate fund will never be closed. That's my feeling. So there's other options at Cobas. They're very interesting and quite decent. The large corporate portfolio has had a good performance, especially in the last few years. And I think that it can also give us a lot of reasons to celebrate in coming years, but it is what it is, and that's it. We could do mass campaigns and acquire a lot of customers, but that's not the business that we're in. And it's true that at a given point, if we close these funds, maybe we'll consider alternatives like a fund of funds. And as we saw in the beginning in the presentation by Santa Comba, we Port Palm Harbor, Peter Smith, is he here?
He's managing Palm Harbor. He is bueno, no español. Lleva 7.
For 7 years, he has been managing Palm Harbor with 10 or 11% yield at an annual basis. They're doing better than Cobas, I think. And they do things that are different to what we do. The fund's smaller. And we're talking about smaller companies, and these are some of the alternatives that we have in the market. And by the way, when customers cannot become new customers for international or selection, we'll give them a series of alternatives of people we like and that we are reassured about. And I'm sorry, but this is the way it's going to be. And about our strategies, Agustin was asking, what's the difference between large corporates and international? Could you tell us about the core of the two portfolios? Well, there's public information about this, and I could draw you could draw the comparison yourself. Approximately, the large corporate fund allows us for 25 to 30% of that fund to be with companies that are less than 4 billion, and that includes all of our selection companies too. And this is the way we work. And the remainder, 60% roughly, is about large corporates. Some of them are in both funds. I'm thinking of Bayer here. Hutchinson, for instance, actually, or CKH rather. It's 4% of the international portfolio and 7% of the large corporates portfolio. So there's quite a bit of an overlap between the two portfolios. When this is closed, we ourselves will have to invest into the large corporate portfolio. It potentially won't have the same yields as the selection portfolio and the international portfolio. I don't think one will be 7 and another one will be 12. I think one will be 12 and perhaps the other will be 10%. Kirsten is saying with the current corrections, because of the Iran war, that can escalate actually. I'd like to know what the percentage of liquidity that you have in the funds is in order to perhaps increase the positions that you have in the portfolio, and to also consider whether you have an entry point to companies that are going down in the last few years and that were already in your radar. At PER 7.8, we will never have liquidity. By the way, if anyone thinks that we have liquidity in case the market drops, we never ever do that, and it's common sense. If we have a company at PER 7 or 8 and we have 1 or 2% in the portfolio, I would be delighted to be 3% of the portfolio with the company. All of us will be delighted with that. I'm not going to make it personal. It doesn't make sense for us to have liquidity. But what happens? Sometimes bad things happen, and we need to play around with our portfolio. We actually had a takeover bid with one of our companies, and we sold part of that company to buy things that were going down. Actually, it's public. One of our important companies is going through a strategic review that could lead to the sale of this company that could entail 4 or 5% liquidity for us when that happens. And it already happened in 2008. In the year 2008, when we had Lehman's catastrophe, what happened was that there were 4 or 5 takeover bids that year, and one of them was Cociba, and it was the very same day that Lehman went down, and it was 15% of the fund. We sold it and bought other things. We will never have liquidity in case the stock market crashes, because it could happen that India continues to increase at 7%, and Southeast Asia grows at 5%, and then Africa is growing more than Asia, surprisingly, and very good things could happen, and as has happened in the last 35 years. Bad news too, wars, economic collapse, and spectacular growth for Europe and the United States in the 90s. and spectacular growth for China and other countries in the 2000s. So good things, bad things have happened, and we will be invested at 98.5%, 99% all the time. Santiago was asking about the impact that the potential recession can have because of the current situation and the destruction of demand that this could bring about too. Some analysts say that the damage caused by the conflict is already done, and if the global economy goes into a severe recession because of the high energy cost, oil demand will fall faster than supply can resist. Should we invest into energy, taking advantage of the conflict premium, or will there be structural scarcity and we should maybe harness this in spite of the demand destruction? Well, it's very complicated. That could happen, and the opposite too. And alternative options too. We cannot even agree on the past. How can we agree on the future? I don't know who said that. It was Churchill, I think. But it's impossible to tell what will happen. We need to adapt to whatever happens and make the right decisions on the basis of what happens. If the demand is destroyed, it could happen, but things could be normal in 1 month's time. So we don't really know what can happen. Let me share a story. I was having lunch last week, and there were several admirals, and I asked them whether it was difficult for them, whether things were going to be easily solved. And some people were saying that, well, one was saying that it was impossible, another one was saying it was easy, and the other one was, sitting on the fence. So we cannot really ask about oil demand because we don't really know what's going to happen. You can ask those questions for fun, but you cannot make your decisions based on those answers. You make your decisions based on the market. If oil companies go up, our tendency is selling, not because demand is going to be destroyed, but rather because markets will adjust. And when prices go up for things, then normally consumption will be lower. And after a while, there will be more oil to be found in sources where before it was not efficient or profitable to draw it from. So things happen and then we act, but we cannot tell what will happen. For instance, for oil, Juan, why don't you say something about oil? Tell us about what we do about oil, because I don't want to be the only one speaking here. Well, we've mentioned this several times. We have a future forecast of $60 Brent with current prices. That is quite conservative, apparently. But at that price, our company's valuations actually work out quite well. And this is what Paco was saying. I don't have a lot to add. We are not fortune tellers. We don't know what's going to happen given the geopolitical context. But we think that the marginal oil barrel in the long term could be at $60, $65. No one knows the exact figure, but we think that at that level it's quite reasonable, and we could balance out supply and demand. And that is the price that we use in our valuations and in our models to estimate value for companies. And at $60, $65, the companies that we are invested in have high potentials. Now, with the revaluations that are taking place right now, those potentials are becoming narrower, and this is something that we are harnessing to undo positions in companies that are related to this, and to invest further into other that are unrelated to oil. This is like a natural hedge. It's an unfortunate situation, but from this perspective, it's been tailwind for us. Before we move on to the next question, I go back to the closing of funds because apparently there's some doubts. They're asking whether Cobas Selección and Internacional, those that are still there, that are now there, can they continue to subscribe? Well, we need to speak more about this. For A, B, and C, for sure, but for Class D, I don't think we can add more into Class D until 3 years don't go by. So if anyone wants to invest, they need to do it now, right now, into D. Well, we'll have some time for the whole process to unfold. Of course, it's not going to happen over time. I thought would like to know what we consider to be the most recent investment errors in specific companies and why we made those. I'm going to reply because these were my mistakes. In the team, we make decisions by consensus, and in a couple of cases, I pulled out the wild card and I got it wrong, and the company went bankrupt. It was Anacol. It was a gas company in Colombia. That's the most relevant mistake, I think. And see, Chris. That was another oil and gas company. We did something that we should have never done. Well, not exactly, but we went for an OPV, and rarely do we go for an OPV. And we did it. We trusted the industry. The assets were good, but the management ultimately was not that good. These are the two that we mentioned before, and that I think we need to underscore in the last 4 years. I don't think we've had any others. Fortunately, in Spain, we've had none. Well, right now, I don't know whether there's some hiding under the rug, but I would mention these two oil and gas companies. Alejandro was asking about how we took in the takeover bid on Fnac and what we think about G3 Apparel and Douglas. Carmen. Well, Fnac, that's the case that you were mentioning before. There was a friendly takeover bid on the company. It's not an exclusion takeover bid. We continue to have our position, but it's true that they did this at 36 euros, and then the market, the share price kept up at 35 when many of the companies in the portfolio dropped significantly. So we reduced our position there and invested into other things. Not because we like Fnac any less at those prices. We think that it has great potential, but it's matching a moment in which other companies are performing worse, and we took the occasion to reallocate our capital. And then about G3 and Douglas's thesis, these are two retailers that are very different. G3 Apparel is a fashion company that we have been investing into since we started in Cobas. When they go up, we sell. When there are some downturns, we buy. And it's a company that we're into because of the management team. We have received wonderful feedback about them always. And for the last 8-9 years that we have been invested into a company, the feedback has always materialized. And this was a company that held a series of fashion licenses, Tommy Hilfiger and Calvin Klein, and they're now transitioning towards their own brands. And because of Trump's tariff policies, the company is going down, when we actually think that the new brands, which are Donna Karan and Karl Lagerfeld, we think that they will have a long or a good future ahead of them. And most importantly, we are supporting the management team. They've done the job with other brands in the past, and they did it so well. And the CEO, the son of the founder, has 10% of the shares. Everything's invested in there. That's about G3 Apparel. And Douglas is a recent inclusion into our portfolio, but I think many of you know it probably. Is number one in beauty cosmetics in Europe, and it's a company that was listed a couple of years ago, 20 euros per share, but now there are 10. When they went into the market, the underlying market was growing a lot. There were good growth perspective, but those growths have now stabilized because there's been boom after COVID in fragrances and cosmetics, and it's going to continue to grow, we think, but we think that it's being overly penalized by the market, and they're at 6 times prices. When Ulta Beauty, they do the same in the United States. They are at PER 17. So the market has presented us with a very good investment opportunity when many of the companies are doing well. We are taking advantage of the situation to invest into these other ones. Now, let us talk about Técnicas Reunidas. José Eduardo is asking the following. I'm a subscriber of the fund, and I'd like to know your current perspective on Técnicas Reunidas after the important rally of their share price. Considering the current war conflicts and the infrastructure crisis, how do you value operational risk in the Middle East and the opportunities that will arise because of the needs for reconstruction and energy autonomy? Specifically, do you think that the company will manage to consolidate their margin and dividends for 2026, or do you think that the geopolitical uncertainty is weighing them down enough to readjust their objective valuation of the business? Well, in the short term, who knows? It really depends on how long the conflict lasts and the turn that it takes and what the reality is. We have a lot of contact with Técnicas Reunidas. They continue to work on their projects. They haven't sent people back home. It's true that some relatives, children, etc., have been reallocated from, for instance, in the Emirates, but the core players are still working on the strategic project for this country. So currently, the projects haven't been cancelled. In the short run, we will see what happens. At any rate, this would be a short-term effect. Actually, in the long term, the more infrastructure that is destroyed, the more work that Técnicas Reunidas will have going forward, because these companies make a living out of these infrastructures. There is uncertainty in the short term. It looks like it has impacted the share price. Técnicas Reunidas has decreased their share price a lot this year so far. Will they meet their objectives this year? No one knows. It really depends on the evolution of the situation. But I think that mid and long-term objectives could be met. They established very realistic objectives, and Técnicas Reunidas has really put their actions where their words were. They had an investor day, and they reviewed their group strategy in September. They actually increased their financial and operational targets, and they actually presented the results recently, and they increased their objectives, obviously before the war, though. We are fully convinced that in the mid and long term, they will uphold their perspectives. But what happens in 2-3 months' time, it's difficult to tell. Javier is asking us whether they could, you could share additional information about the management criteria for the pension plan for Cobas Global. The pension plan for Cobas Global is a clone of Cobas Selección. So when you buy a share for Cobas Selección, you buy a share for Cobas Global. About Golar, José Luis would like to know what our target is for this company and what our expectations to exit. If I may, we don't share the target price per company due to obvious reasons, of course, but they are at a historical maximum. Before the conference, they were at 54.5, and that is a historical maximum and a record maximum. And in the last years, we have been selling at important amounts. Not last year, they contributed to the increase of the fund this year. And, you know, we are keeping an eye on the company. The company is not very happy with the share price. So they have publicly mentioned that they are taking steps to see how to improve the share price. And we are in a wait-and-see position. And interesting things may happen in this company, and if they don't happen, from our perspective, the company is worth more than their current share price, and they're our larger investment currently. And we must remember that they are benefiting from what is happening, irrespective of what happens with the oil and gas price, because no one in their right mind will now take on the risk that was assumed with oil or gas from Qatar, the greater gas producer of the world, with the problems that this could entail going forward. Right now, going forward, there will be more diversification in gas sources. And Golar is at the forefront in order to do that, because they have ships that can liquefy gas in any place of the world, and they can serve gas anywhere they wish. And it's flexible, low cost, and this is why their share price is at a record high. When share prices are record highs, it's an art to see when to sell, and that's what we're working on that part of the art. Ricardo is asking about Wizz Air. What is your perspective on the company currently? Does the investment thesis remain, or has it changed due to the events that have recently unfolded? Why don't you answer that one? The strategy hasn't changed, but of course we have slightly adjusted our target price because fuel is a bit more than 1/3 of the cost. They have hedged for the fixed fuel at 70% over the year. It decreases slowly but surely, and this is going to be detrimental for them. But on the flip side, we're seeing increases in prices in airfares. They are adding an extra cost linked to fuel, but in the long run, something that we were discussing internally is that if fuel prices remain at this level, this will impact the whole industry. It may impact demand, but them and Ryanair, they're the most cost efficient. So if they're the most cost efficient, some others will suffer more than they will, and this will offset slightly the loss of demand. So we have adjusted our perspective a little bit, but nothing dramatic that changes our investment thesis. Paco, would you like to add any comments? No, truly, we had never invested into airlines before, perhaps a little into Iberia in the past, but the objective position is quite good, and they're the second low cost in Europe, together with EasyJet, but truly they're low cost together with Ryanair. And just a couple of figures: Ryanair is in this has a value of 20 million in the stock market, and Wizz Air is 1 million. And it's not the same because Ryanair owns their planes, they don't have debt, etc. But intuitively, there could be value there at Wizz Air, and it has a little bit of risk because it's the air industry, but they're the most efficient operator in Europe together with Ryanair. Things will happen there. They have a temporary problem, like most of the companies that we invest into. In most of them, there is a temporary problem. They've had some issues, not just Wizz Air, but all the companies that were using Pratt & Whitney engines. But this is going to be fixed over the course of this year and next year, and when the problem is fixed, they will be in the right condition to compete on the market. They're a bit short-sighted sometimes, and they do not see 2 years into the future, and they will see what they are ultimately. It's a good company with a very important competitive advantage, especially in the east of Europe, where is their place that they come from.
Jorge is asking us, what's your opinion about if also the business is growing, the debt is going down, the corporate governance is increasing, but the valuation is at the minimum possible level? That's a very good question. I wonder the same thing. It's a corporation that basically, as you said in the company, their revenues over the course of the last 3 years have grew by 20%, EBITDA has grown by 50%, and the cash flow has gone from being negative -450 to plus 450. So operationally speaking, they seem to be doing things correctly and they're improving. And there's also been an improvement in corporate governance, but this is not being translated in the share price. It's still a bit depressed. It's another example that probably requires us to be patient. In business, you have to take a look at the future and the coming opportunities and the risks involved, and this is something that we're also taking into consideration. We're monitoring risks, such as the threat of some competitive products, such as Grifols products, and opportunities that they have with their own pipeline. For example, the obtention of plasma from Egypt at $100, the collection of a little bit of plasma, versus in the United States that is $200. So you can obtain this 100 million surplus. So with this, I mean to say that there are positive things, negative things, and the market tends to look only at the negative ones, whereas in our valuation, we try to weigh risk and opportunities and do an adjustment based on odds. So when we do these type of adjustments, we think that the investment case is valid, and that's why we're still convinced of our investment. And even with the drops that they have, we've been able to increase our position. And what's interesting, like in the case of Grifols, as it is in other cases, is that we're totally clear about it is worth much more than is recognized in the market, and that's why we've been able to increase our position. We've spent last month increasing our position in Cobas in the Ibérico, and it's a great opportunity. It's a great opportunity. Just need to wait. Getting bored and being patient is our competitive weapon. Thanks to that, we can increase our position and the way that these type of companies have in our portfolio. And at the end, it pays back. The same thing happens with other companies that are having a minimum price valuation or share price. What do you think about the current investment opportunities in China or in Southeast Asia in general? And we have another question about Asia from Nicholas, who's asking about the approximate percentage of profitability in our funds coming from our exposure to Asia.
Is in China, what the opportunities have in Southeast Asia, I don't know, the opportunities are in general.
Oh.
And
So I think the problem is, the question is about the opportunity in China. So I think we have been, in the beginning, why I was here, because we have invested in China related. So we don't necessarily have to invest in Chinese company, but we invest in many things that are related to China. So my personal view, I still think there's a lot of growth for China, because if you go there, you can see the way they do things and the entrepreneurship in the economy still driving a lot of growth ahead. So I think there's many things, opportunity we can find there. But the question is, where do we find the opportunity? So I think, for example, with the growth of economy, they need energy, and we invest a lot of things in energy. So that's one of the way to think of that regarding China, in my opinion. And also, I don't know if I update you, but I was moving myself, relocate from Shanghai to Singapore about 1 year ago. So now I'm based in Southeast Asia. So I get more opportunity to see more things in Southeast Asia. For example, in Cambodia, in Vietnam, in Philippines, etc. So we do kind of expand our geographic exposure to other countries in Asia as well. So that will bring us more opportunity, I think, it already some, but more in the future.
There has been translation, or? Y lo traduzco yo. Bueno, la verdad es que hemos estado investigando.
It seems like they were not hearing the translation. He's saying that at the beginning in Asia, we were being very attentive at what was going on in China without interpreting directly. In Hong Kong, we are investing in companies with activity in China and others without activity in China, such as who has no activity in China, and we're open. Right now, we have 2% of our portfolio in Chinese businesses, approximately, but we are expanding the scope. We have in between 15-20%, depending on the moments of Asia exposure. We've always been in Korea, Japan, Hong Kong, and now, as Min Kun is saying, because he moved from living in Shanghai to live in Singapore, and he's more actively looking at some countries in Southeast Asia, such as Cambodia, Vietnam, the Philippines, for possible opportunities, and we'll be quite attentive to the opportunities over there. It will never be a huge investment because it will be competing with the investments that we have in Europe, but Min Kun and others have provided with very interesting ideas that we've been able to apply in our funds and have given us a certain stability, because sometimes the movements in the Asian markets are different to the ones that we have in Europe and in the US. Xavier is asking about Cosmos Energy. In this very last month, Cosmos Energy has done a very important revaluation. It's been threefolded. Do you regret leaving then? We haven't stopped having a position in Cosmos Energy. No. In fact, they did a capital expansion recently. We've participated.
El peso en cartera ha bajado como producto.
We've participated in this capital increase. We've not sold our shares, and in fact, they have threefolded right now. And it is one of those companies that, if the price continues of increasing, because it's highly exposed to oil prices, we will continue on considering what we're doing. But yes, it's 2.5, the price in the portfolio. Mario wants to know the role of AI in the thesis of teleperformance, and if they can lose as much of a business as the share price is discounting. What relevance has capital allocation in this thesis? Teleperformance is one of the most complicated investments that we have right now in terms to the visibility for the future, because as the person who formulates the question says, AI can mean disruption in their business model. They have two key businesses. One of them is customer service, all outsourced services such as call centers, but not only call centers, consultancy on how to improve businesses, cybersecurity businesses, defense of against cybersecurity. But historically, was a call center company has reinvented itself over time. With AI, we definitely have doubts on how AI could impact the call center businesses. If they're going to continue on needing so many people, if the doubts that people have when calling their power utility, with those doubts can be answered by a machine or by a human. And then there is a second leg of the business, a second branch. It's quite diversified, but they also have a translation and interpretation businesses, live translation and interpretation, mainly in the U.S. For example, in a court of justice, a key witness who does not speak English, and they need to look for an interpreter who will be doing the interpretation of what the witness have to say, or someone getting into an emergency room in a hospital with a medical emergency who doesn't speak English. Most of the hospitals in the U.S. have a simultaneous interpretation system 24-hour with teleperformance, so if they get into the hospital with an emergency, they can receive the live translation. But the business that was supposed to be more impacted by AI is resisting much better than they initially thought. In fact, there's even a certain organic growth of 1-2%. And the one that has been more impacted by AI is the interpretation and translation business, not because of AI, but because of the new Trump administration is going against the immigration, and they are simply stopping providing this type of services. This is hard to explain in a summarized way, but it is a company whose cash flow has tripled with no debt, because it generates close to 300 million euros per year, and is still stable despite AI. It's been in our lives for 3-4 years in a more significant way, still resistant. Its business model is still operational, and they create or generate cash flow. What does this mean? We need to decide whether if it's still attractive for the next 3-4 years, or if, on the contrary, the risk posed by AI is an excessive risk, and therefore it's not worth it. And that's why we've limited the weight that it has in our portfolio, because it's hard for us to exceed that weight that it has right now in our portfolio. And that's all that we had to say, basically. That's the circumstance that we're living now. And in terms of the capital allocations, is so cheap. We have doubts on whether if they're going to do a stock buyback or not. They had a change in the corporate governance. The all executives of the company have left, and new executives are arriving. They're more familiar with AI, trying to have the company adapting better to the new challenges ahead. So it's undergoing a transformation process right now, but the price is 3 times the cash flow, attractive enough as to take on the risks. Probably I forgot to explain everything, but it was a good summary. Manuel is asking how to identify the limit between being patient and being stubborn and irrational in our investment. When do you identify that you've made a mistake? Sometimes it's hard. What you can do is certain tricks such as capitals on returns on capitals that are high. That means that there is no trick here because they can make more money selling to their customers. You're in leader businesses. Well, it's hard to have a value trick there. So moving towards high quality companies of high return help you to prevent these issues. This is never 100% inevitable, being tricked by the value of the company. This is not 100% inevitable, but if you go into quality corporations, you prevent these issues. But there is no magic bullet. Manuel is asking about a real estate bubble in large cities in Spain. It's hard to say. It's hard to say. There's definitely a demand problem. There's clear demand and there's lack of construction. So normally prices go up, but it is true that the prices are, I don't know if anyone can afford a house anymore. They're too high for anyone to buy a house. So I don't know if there is a bubble like the one that we had 20 years ago in terms of overproduction and excess supply, but there is definitely a bubble of too high prices. So personally, and without having a crystal ball, I have the feeling that the prices are going to be either stable or dropping in the next 5 years. But it's hard to say. It's hard to say because we definitely had a problem of supply, not only in Spain, but in many European countries where building houses is very complicated, more difficult than it was 30 or 40 years ago.
Tenemos inversión en el sector inmobiliario, tenemos
So we do have moderate investments into real estate at moderate figures, and well, we need to see what the movements that could happen in those houses. I mean, there's no easy answer for this. I personally believe, or my recommendation is to hold back, to wait a little bit. I don't think it's a good investment opportunity because there's yields of 1-2%, and it's always been low, of course, but the return on a house, it's very little right now. I would certainly wait. Alberto is asking us, don't you see value in the defense industry? Are you buying shares again? Would you like to speak about this? I actually got a backup handheld mic. Well, in order to invest into defense, you really need to speculate about the country's defense budget, for how long they will keep that budget. And that is not the business that we're into. We know how to buy cheap, but we don't really know how to ponder what a set of politicians are about to do, because they might be in one position today and tomorrow we don't know. So the quick answer is actually no. Allow me to dwell on this a little bit. Whenever things are fixed in the Ukraine and in Russia and, of course, Iran, 6 months afterward, I think people actually get cold feet because there's no money for the defense plans that they're considering. And in the heat of the moment, people start considering a lot of things, but I don't think there will be they will be fulfilling these promises. So I would be very careful with defense companies because there's too much competition for the expense needs that actually states have, mainly pensions and other. And given the indebtedness ratio of all states, things are very difficult. You cannot really increase a lot the defense expenditure in 5 years' time. Agustin was saying, okay, it's impossible to tell the future, so I won't ask you what you think will happen. But in the stock market, do you see notable differences compared to other crises? Yes, we are more skeptic now. I remember the first Gulf War in the year 92, 91. Markets fell by 15-20% before the first shot was made. And when the first shot was made on the 15th of January 1991, I was actually visiting a factory, Apuleva factory in Granada. Then the market increased by 15%. So everybody has understood that things, this too shall pass, and this conflict shall pass with time. It'll take shorter or longer, but it shall pass. And we do see that increasingly wars have a lesser impact. We learn, actually. COVID happened, it was unprecedented, and there was a big impact. And if a meteor falls or hits in 10 years' time, there will be a big impact, not just a physical one, but also on the markets too. So things that are unfathomable, of course, cause damage, but they're unforeseeable. Why think about this? I really love that he assumed that you cannot tell the future, because people oftentimes ask us about the future. So it's good that he has already assumed that. So congratulations. Talking about the future, they were asking us where Cobas will be in 10 years. We will be here, buying tomatoes and selling sausages. Good old business. There's younger people like Carla. I don't know how old you are, Carla. I don't know. They will be here. I don't think there will be problems. Salvador is asking, do you think there's value to be found in the automotive and auto parts industry? Or do you think that there's structural flaws in there? I think car seats will remain. I don't see that there will be issues with infrastructure. I see a problem with Chinese competition, but there's no structural problems. Of course, the ICEs have their issues, brakes and that sort of thing. I don't think that's a problem, but you need to take it case by case. It's like anything else. You cannot make blanket statements here. You need to analyze subsegments of auto parts and the automotive industry. Gestamp, for instance, they make the plates or the body of the car, for instance. In your portfolio composition, are you taking into account a potential crisis in private credit? Well, it's difficult to answer because in our consumption companies, there could be an impact. But the debt of individuals in Europe and the United States after the big crisis in 2008, they don't have a lot of debt. Look at the Spanish case. The mortgages have been falling for almost 20 years. Now they're slightly going up, shyly. So there is no private debt in the hands of individuals. There's a bit of a bubble in corporate debt and private equity transactions that entail indebtedness. I don't have the feeling that individuals are very much in a debt bubble, neither here nor in the United States. People are not becoming overly indebted, I don't think. But it's difficult to know where the problem will lie and in what segment of credit the problem will be found in 10 years or 15 years' time. It's difficult to tell that, so it doesn't make sense to be concerned about it. So we'll finally ask a few more questions. Jaime is asking, what do you think about companies that have a lot of goodwill in their balance? Is this concerning? Let me answer. I don't know if you guys have any opinions about this. Those of you that actually give lectures, well, goodwill is truly the premium that you pay for acquiring a company. It's not a value that is intrinsic to the company, but rather a premium that was received by a third party. When companies agree on a price, the seller will sell because you're offering a bit more than they're asking for. So from the accounting perspective, that needs to be reflected when the transaction is made, and that is done on the goodwill. When is that a danger? When the goodwill has been overpaid and you need to do an accounting impairment because it's shown that the asset of the business that you bought is worth less than what you paid for it. So that way you need to do accounting treatment. It's not a cash outflow, but it's actually a loss, and that needs to be put through the P&L, and therefore it reduces capital. So that from that perspective, it could be a risk. But I get a bit technical from the accounting perspective, but I don't think there's an additional risk apart from that. It just goes to show whether the current or the previous management team has been performing transactions in which they have been overpaying in their acquisitions. And that's the way I see it. Totally, indeed. Emilio, any opinion about the evolution of the corporate market in the mid and long term? Are we invested there? To what extent? You know, that's, again, future telling. In the short term, I wouldn't know. No clue. But we actually consider what projects are being sanctioned and what projects are being performed, what projects are actually on standby and will resume in short, that sort of thing. So we use a conservative copper price, and now it's listed at 5.5. So we normalize it at 375 for you to get a flavor. So we're very conservative from that perspective, from the analytical perspective. It's true. I wanted to talk about raw materials. We're conservative because actually the market sets the price. Companies can do very little as this. And for copper, we use 375. For oil, it's 60. These are quite conservative prices. And if we miss out on things, then we miss out on them. But we can sleep at night, nonetheless. But something that we do is that while being conservative, we do know that it's cyclical by nature. So if you come by at a moment when the share price is affordable, copper is affordable, like Atalaya. Atalaya was bought between 2 and 3, and then most of it was sold between 10 and north of 10. So that gives you a flavor of when to buy and when to sell. Okay. One final question so that we can abide by the schedule. Gregorio was asking, how is AI impacting the day-to-day of fund management? Well, I actually asked it about investment ideas, and the results were still useless. But the team is actually using AI. Why don't you share your experiences, what you're doing? Well, it greatly reduces the most tedious tasks that we have to be performed before. It's true that it's not perfect. You need to truly review it. But it causes us to be more efficient, and it helps us devote more time to the part that has more added value. And it's difficult that the AI will be able to replicate that. But I would frankly say that it's helping me, potentially all of us, with the most painful tasks of our work. So that is quite fine, I think. I would summarize it in saying that it helps us summarize everything that we're doing. For instance, one investor day, well, he gives you a brief summary of everything that the market thinks about that company. So it's good for summarizing. It's a useful tool. But I don't think it can recommend. I don't think it can think. That's not something that I see it's doing. But it cannot replace Carla. Carla works much better than AI. In case someone was thinking about replacing analysts, I think Carla is much better than AI. Actually, before we hired her, she had to compete with AI, and she won. And that's the end of our conference, and thank you, everyone. Hopefully, next year we'll bring you better news.